Hello, thank you all for coming to this talk. I want to thank you for taking the time out of your day. I'm Thaker.
I'm Daniel Sonner, and we're co-founders of Tauroi Technologies. So we'll talk a little bit about who we are. We'll talk about the efficient market hypothesis and the implications for trading. Then we'll give a quick crash course on how the futures market works. We'll talk about applying aerial imagery to wheat futures. If you guys want to follow along, that URL goes to GitHub that has the code we're doing.
So I'm Avi. I've spent 7 years consulting for hedge funds. I've got a couple machine learning patents and some pending. I've also built some document extraction tools utilized by many of the top banks. I went to Harvey Mudd College. I worked at Microsoft as a data scientist, and I also went to GSK as a researcher for cancer drugs, and I've also passed my 65.
I'm Daniel. I met Avi at Harvey Mudd College, and then I went to work for Pure Storage doing systems engineering for about 4 years. I have a patent pending from my work there, and I've won a bridge world championship. So the efficient market hypothesis is the idea that all information is priced into the market. And so if under the efficient market hypothesis, the market would look kind of like the dark orange line in this graph, where it's horizontal at some price with all the information priced in. Then there's some announcement, some new information comes, and the market would get repriced instantly, and it would trade at that new price. In the real world, it doesn't really trade like that. Often information is leaked or traded by insiders before the announcement comes out, and then people can also be slow to react to new information or can overreact to information, leading to different prices. If the efficient market hypothesis were true, the resulting implication would be you couldn't make money trading stocks because all the information out there would be priced in already. There's clear examples, though, of people who and companies that do beat the market, like Warren Buffett or Ed Thorpe or Citadel and Virtu. And one example is in Virtu's 2014 IPO filing. They disclosed for the past 5 years they made money in the market every day except for one trading day. So this would be extremely unlikely, even just due to chance, if the efficient market hypothesis were true. So quantitative trading takes the approach that there are some market inefficiencies that can be traded. For this talk, it'll be helpful to just understand the basics of how a future market works. So one vocabulary term is spot price, which is the price to buy a good now. So for this, we're using wheat futures, so that would be the price of wheat now. And then a futures contract is an agreement between a buyer and a seller to buy a set amount of a product, so a set amount of wheat at a set future date for a set price. And you can see this, and then so you have a bunch of different delivery dates, and then you can synthetically stitch these together to make a continuous contract. And we'll use that for this talk because it makes modeling easier to just have a continuous contract and not have a set delivery date. So we'll be applying aerial imagery to try to predict the wheat futures market price. So the thesis is that images of crops can predict the future price. We'll be using machine learning because convolutional neural nets especially are good at understanding imagery, and machine learning can try to learn the influence of the imagery to predict the prices. We'll be using aerial imagery from Google Earth to look at hard red winter wheat, and then we'll be speculating on the direction of the future price of that wheat.
So let's actually look at the wheat. So this example is going to cover wheat from Washington's, a specific area in Washington. It's these green dots that you're seeing in the center. And we're looking at red hard winter wheat. It's a specific wheat that makes a lot of the bread that you consume. And when I did this in real life, I actually looked at all the imagery across the US and some other regions in the world as well. But I'm focusing this demo on one specific region because it's easier to understand. But in real life, you'll have to look at it. This is a very competitive market now. A lot of people sell data in aerial imagery, and I even wound up having to acquire a farm to go get real data and then having high school students fly drones on top of the farm to actually collecting data faster than everyone else. Now it's really competitive because everyone is doing this. But this is a deep example of what we are doing. So this is what the Google Earth data looks like. And you can see here there's some brown areas, there's some green areas as well, but you need to know where the location of that crop is. And it's really important you clean that data well and you know what you're looking at, so you have a clean data signal and you know where you are looking. So let's look at this data. And so here is the wheat price daily over the last, 50 some years. And you can see it's a pretty volatile market. And so in data science, it's really important that we select an in-sample and out-of-sample because we don't want to be biasing our models, especially when we're in a low data regime. So we want to use neural networks, we want to use deep learning, but let's look at why it works, what is happening. So in the early layers and the small layers of CompNet, it learns local features. You can see that up there in the gray boxes there. They're learning stuff that's mathematically as a difference of Laplacians, difference of Gaussians, but it's learning it automatically, and it's learning the feature detectors that do that. And then further layers up, it learns stuff like face features, round features, etc. And then later, it learns even more general features. So what we're going to do is we're going to take a model that Microsoft published, we're going to take ResNet, and we're going to take a model that's already trained on this stuff, has already learned these local contrasts of things, and works on so many different images. But then we're going to take off the back couple of layers, and we're going to say, okay, from these back couple of layers, we're then going to apply it to our wheat features to have it learn something about what's going on in this area. We're also going to combine it with the time series data. We're going to do a multimodal approach. And any questions here, I want to make this interactive, so if people have questions, feel free to just interrupt me, raise your hand, shout at me. I don't take offense. And so this is what our model looks like. So you can see up there in the top right, we have our picture input. So it's a 2D layer. We have a time series input, which is the historical price, and we have an output dense layer. Our goal here is to predict what is the wheat price going to look like 1 to 6 months in the future. In this example, we're going to do 1 month in the future. We want to predict the direction and then see, are we making money with a positive expected value? The cool part is in Keras and PyTorch, etc., you can really easily represent this. So all you have to do is just say, I have some input. It's a 64 by 64 by 3 pixel. I also have a time series input. And then I can concatenate them together, and I can learn a dense vector. That this dense vector represents the encoding of both of these together. And so the cool part is now you can encode multiple types of data together. And if you understand that, the computer can learn how to combine these data together and then predict things in the future. So let's look at how this model did. So we trained the model from about 2000 to 2011. And then we held out a sample, and we just looked at this data in one specific area. And this notebook is online. I can share it as well on my GitHub. And we can see how it did. And so we can see here from predicted versus actual, we were wrong the first time, but then we started being pretty right. And this is real out of sample returns. And so this was right about 63% of the time. And this had a Sharpe ratio of about 1. And it made about 30% over some sort of years. It's not a ton of money, but when you can do this more frequently, more commonly, you can make profits very systematically, very efficiently, especially when you tie in stuff like earnings dates or in the price of wheat when crop yields are announced, when farmers do stuff, because you think that you have an edge in where things are going. So sometimes you're not forecasting price, but you're forecasting what do I think everyone else is going to do, and what is their response going to be?
Sometimes also ML is only a fraction of the work. So to operationalize this, there's lots of work involved in the data collection and the data verification, but then also in the infrastructure to do the trading, the resource management and the monitoring and the configuration to actually turn the science into something that can be traded. And so this image by Google has the boxes about proportional to how much work and or how much time is actually spent on taking something like this and making it tradable. The other thing to really watch out for anytime doing models and applying them to market is the backtesting risk. So in the example we showed, we would do a backtest there to see, okay, if we bought it here, how the price changed, how much money we would make. There's lots of things that you also have to consider. For instance, there, it did not consider trading fees. So in order to trade, you'd have to pay some fees. Also, usually there's a gap between what people want to buy for and what people want to sell for. So if you want to make a trade, you have to overcome that gap, which is the bid-ask spread. So you have to account for that cost as well. And then there's the issues in terms of curve fitting or over optimizing. If you try out too many ideas and you just get lucky with something that looks good. It's really important to be rigorous about an in-sample and an out-of-sample split. And it's also really easy to introduce forward-looking bias, especially if you misalign your data. So maybe you accidentally look at the future image of wheat, and then that's going to be very predictive, but you can't actually get that data. And then the final risk to mention also is just the human element of, would you be willing to trade it? So in the back test we showed, it was a profitable model, but for the first 4 years or so in that out of sample, it actually didn't come to break even. It only made most of the money at the end. So would you have actually held out and realized your edge on the market?
So I want to thank you all for attending the talk. We run a hedge fund called Tauroi Technologies. You can go to our website there. If you have any questions, want to learn about how we think of alternative data, use alternative data to predict markets and solve a very specific area, we'd love to talk more. And I'm excited to answer any and all questions you guys have. Daniel and I both about trading, computer vision, anything. Question there?
Well, sometimes there's cultural practices and harmony and skill value for a while. In the Midwest, there has been a disease that we started like, and although the plants may look okay, there may be toxins associated with it. So is that what's in here?
Absolutely, and that was one of the motivations for actually getting an investment in a farm, was understanding where the problems actually are. And so what happens is that it's not always just the aerial imagery, but we actually put Arduinos all in the field and Raspberry Pis in the field to monitor soil levels, pH levels, and actually look at, well, the underside of a leaf tells you a lot about how a plant is doing. If you have a yellow spot on that you can't capture from aerial imagery. So you have to combine data from many, many sources and look at getting the hard data to get. Once you can get that data that is really hard to get, that is what tells you. So absolutely, you have to do that. And then people have all different practices. I see one more question there.
What percentage of the predicted wheat futures did your model predict? So, so your model has, you can't predict 100% of the change. You see what I'm saying?
Absolutely. So, the way we measure R squared, so R squared is like 0.7 to 0.8, which is very high for finance. But we are trading when we are confident in trading. So we can forecast on every single one, but we trade when we have a high confidence that this is going to make money. Let's say above an 80% likelihood or above a 60% likelihood. You're not always doing that. You're trying to maximize the expected value. We can talk about the details of that later. But the answer is for this, you're in the market for about a month. You're trading about once a year. So 1 over 12 is about how often you are trading the market. And we're doing a 1 month prediction. And when I actually traded, it was between 1 to 3 months of a hold time.
So just using imagery, you get an R squared like 0.7.
Absolutely. And it's crazy. Now, I don't trade this model as much anymore because it's no longer profitable. It's very hard to do. But back in 2016, when I was a computer vision researcher at Microsoft, well, not many people knew how to use ConvNets at a deep level and take AlexNet was 2015, and then I was doing this in 2016. And so we were right on the edge of right when this came out. And so if you can beat people to data and you can beat people to a better model, you will have an edge for a certain period of time. I saw one more question there.
So it's a time series model, right? So you're bringing the computation part from the area side. Is it going to be just like one feature, okay, the key trade, or let's say 6 months later it's going to be high? Is that actually helping? Because I'm just curious as to how you're using the time series with the prediction part. I believe it could be an estimation.
Yeah, so let's talk about a simple case first right here. And so let's just take out the time series component right here. So yes, there are regions that are going to activate differently. What we are really looking for is come up with the features. So then you can use like GradCan, etc., to explain what the features are. And when I forward prop through that, you can see that, oh, it's highlighting when things are green versus when things are yellow that are different than it is classically over that period of time. So basically, when wheat is being produced, right, they dry the wheat out on the stalks, they whack it, and they take it up. They take it off. And so if the colors are different, and yes, there's a lot of normalization you have to do, it picks up on that. And so a lot of it is the low-level color predictions that are happening from the aerial imagery. When you're going down to lower level stuff, then you have to look at bugs, etc., that are attacking the plants. And you can use GradCan, etc., to see what the model is picking up and why it's picking it up. Or you can use something like Shapley analysis, etc., to tell you what it is. But there's a lot of research being done into this as to why it's happening. And typically you want an explainable thing that makes sense as to why. I'm happy to go offline and go deep into one of these topics.
To add further to this question, this is only talking about the supply side. How the weather can influence the supply of the doesn't look at the demand side.
No, it does not, but that is definitely features that you add as well. This is just a very narrow section, but typically you have this big encompassing knowledge graph that contains all this stuff to feed it all in, so you have a giant multimodal approach that understands how the different factors are leading to it. I saw one more question here, and then you'll be after him.
Yes, we're seeing a region sense and here's a reason for already, I guess, raising.
Absolutely, I'd love to talk to you after this. We are raising a fund now. We are open for investors starting next month, external investors. We've soft launched with our own capital right now, and starting September 1, we'll be accepting money. So would love to talk to anyone who is excited to invest in this. Yeah, it's a contrived example. Typically, the what you do is you take lag differences and you want it normalized. So it's a lag difference, and then you normalize the differences as well there. But it is typically a vector that's about 64 big. It's not the 2 here. This 2 is for students who could run it on Colab and run it in a couple of seconds. So yes, I've tried LSTM, I've tried transformers, etc. I'm more of a ConvNet expert, so I understand how you can approximate LSTMs very, very well with ConvNets. And the thing I like is you can train a ConvNet down to approximate an LSTM very well. And research is now coming out about ConvNext, etc., saying that ConvNets are outperforming transformer models because of what they're actually learning inside of them. So I like ConvNets a lot because you can train them fast. They're very parallelizable. I also do like transformers. You have to have a transformer with a ton of data, and we don't have enough public models yet that are really adaptable in the, you can change up these layers. Because transformer models, right, you're only looking like 4 layers deep versus a deep ConvNet might be ResNet 101, etc. So when you're in a lower data regime, ConvNets strongly outperform transformers or LSTMs due to low training volume. Oh yes, absolutely. You can do that, pre-train that, and then combine them together. Absolutely. Question here, and then one over there.
It's a very fragile commodity. It's still being traded. Do you do analysis of international fields production or understand the incredible so they might have to all the cheap?
So yeah, and one of the reasons why I've stopped trading this is there are macro events that can just whack your portfolio. And I was fortunate to stop trading this model before the Ukraine crisis happened with all of this stuff. But yes, you need to encode time series, news, etc., into all of this stuff to help understand very generally what's going on. And so sometimes your model can't handle all of it. And to do that, you have risk limits in place to set, my model does not understand this. This is trading, get out of it. So the answer is you want to incorporate as much as you can, but you can't cover everything. So know when your model can say, this is out of whack, and this is trading not how I expected, and have it handle it. Does that help answer your question?
Yes.
Basically, everyone was coming in the space, and people were selling this data, so I no longer had a data advantage. And we started moving on to other models that were more performant. And so I can talk more about this offline, but models typically have a growth, continue, and then a decay phase. And then when stuff starts decaying, you want to get out of it and start having a good framework to research new algorithms. I saw a question over there.
Yeah, you kind of answered it, but I was wondering about, it makes sense this is 2016, and it sounds like we've tried other stuff. Do you find a trade-off between state-of-the-art cheesing versus like novel applications that it sounds like there's a point where you have to?
Absolutely, and it's a balance you have to always do, and it's also expensive to train these models, right? And as a shop of two people, you have to really, really trade off that balance. And I also find that state-of-the-art may be state-of-the-art in a paper scenario. Like, yes, I pushed MNIST by 0.1%, but it really doesn't actually work unless you have a gigantic data set, or you're just overfitting some overfitting parameter. In trading, you want a general model. You want to be very, very good at building something that has general features as to why it works. I think we're almost over time.
Yeah, we can do one more question.
I'll take one more question here, and then us will be here answering questions offline. I can meet you guys right outside the door over here.
What was your process for deciding what contribution?
That's a fantastic question. And the short answer is the expected value was the highest in my in sample, and it showed okay out of sample. And so you can basically train a model to forecast how long it is, but you wind up plotting what is my profit for a 1 day hold, 2 day hold, 3 day hold, 1 week, 6 month hold, and you overfit, but you're hoping that you found something general and it should follow some curves that looks like this. And then you find some tangency point there that you optimize for, and you find a tangency point, you hit there. I go a little bit before that tangency point, because if you go before that tangency point, you don't want to try to be maximizing this. You want to be in a region where you can capture it. And as Daniel was saying earlier, bid-ask spreads, fees, etc. You want to be in this before you're going to get whacked. And so I like being a little bit before that tangency point.